Okay, thanks very much. Okay, so I'm going to just admit everyone now. Good morning, everyone, and thank you for joining our Nedgroup Investments Global Emerging Markets Equity Fund update for Q1. During these difficult times, we want to support and equip you to proactively manage your clients' concerns. This telecon will be recorded and the replay will be made available on the web. We have already shared the presentation slides with all participants and will refer to these during the call. Please note that we will feature a live Q&A during the call. Please just type in your questions into the dialog box on your screen. We will endeavor to address as many of them as possible during the last 10 minutes. Our topics for today include a Q1 performance review, current positioning of the fund, and outlook for the rest of the year. This morning we have Ian Beattie, co-CIO at NS Partners, calling in from London. Good morning, Ian, and thanks very much for joining us.
Thank you, Anil.
So, Ian, the fund just had its first anniversary. You've been managing GEM mandates for almost 30 years now, so it adds to your track record. And what a way to go through the 1 year. It's pretty much a 6% alpha over the year.
Yes, not the sort of market developments or global developments, obviously, that we thought we'd see. Yet another crisis in my career to deal with and hopefully find some opportunities in. But yeah, it's been quite a 12 months. So obviously we really prefer to have that outperformance on a positive nominal number, but at least we're the right side of the index. Yes. So shall I go straight into the presentation? If we go into page 1, for those of you that are looking at it separately, we've just got the stark numbers. And that's showing that over the 1 year, the fund is down 6.21% against the MSCI Emerging Market Index that is down 12%. And year to date, with the market turmoil, we are down 13.78 against the index that is down 16.55. And since inception, as Anil said, is just over the 1 year, so it's down 6.4%. With the index down 12.23. So a healthy gap between us and the benchmark, but obviously we'd prefer those numbers to be more positive than that and to be on the right side. So I've done a sort of year-to-date summary really of what's worked and what hasn't worked for us and what we've done over the quarter. So for those of you that are very tight for time and just want to know what the fund's done and what we did and all the rest of it, this is your one-pager. What worked? Well, we had very good stock selection in China, in Korea, in Taiwan, in South Africa and Poland. And we also are underweights, well, underweights anyway was probably quite good over this period, but underweights in Brazil and South Africa were very positive as well. But not everything went our way. And we had some energy and some hotels in the portfolio. Now, we were very, very underweight energy and had been negative, but we did have some. And the hotels, obviously, this is not the time to be owning a hotel or restaurant business. And that shows up in our Thai and Indian stock selection, which was negative. So the sort of best 3 stocks that we picked out really were in number 1 place, yet again, was a company called Anhui Conch Cement. This is a regional cement producer, and it has incredibly strong market position and therefore pricing. This is a company that makes a decent return on invested capital throughout the cycle. So it is profitable, both in the good times and the bad. And that's because of its oligopolistic nature, very strong market position, and the fact that it is difficult to transport cement geographically. The second stock that again worked for us is another old favorite of ours, China Education Group. Very strong financials, very strong governance, and probably most important of all versus its competitors, very strong academic results. This is a higher education college and university and older age group school group in China. It's not the after-school tuition of the US-listed players. This is China-listed, proper education company run by genuine educators and founded by educators and ex-Ministry of Education officials. So a very good reputation. Parents are not asking for refunds or discounts after the lockdown, but in fact want to make sure that their kids are on the in the school at the start of the next term in September. So the financial metrics of this company have been incredible during this lockdown. And then Act On Technology has also done very well. IT has generally been very good for us, as you'd imagine. Beneficiary from increased demand for data center equipment and 5G and all the kit that we're using as we try and work from home or work in different locations to normal. So we added to those names in Taiwan. Taiwan makes a lot of this equipment that we're all using probably right now. Now, not everything went our way. I mentioned the hotel companies, and Lemon Tree Hotels was obviously pretty badly hit by the lockdown in India, which has been draconian, one of the strongest anywhere, but we are starting to see that lighten up. The second one that hurt was Locas Renner, which is a very high quality Brazilian fast fashion retailer. Very, very strong balance sheet and really good MAUs. We think this one will work as the Brazilian economy does bounce back, and this is a very good play on the sort of Brazilian middle class starting to get a bit wealthier. This should be a very good investment on that. And the third thing that hurt was the fact that we don't own state-owned Chinese banks. So it's very rare that we end up with one of the three worst impacts to have something we don't own. But we don't own the likes of China Construction Bank or ICBC in China. And these state-owned banks, which we don't really like in the long term, probably relative to the rest of the world's banks, well, we're all starting, most of our banks are starting to look like a Chinese bank, I think, in the rest of the world. So that's probably why they've held up a bit better on a relative basis. They have quite good dividends, and life hasn't got much worse for them compared to the rest of the market. And we don't own those. We actually own Indian banks, which I think in the long run are much more exciting, much more profitable, and much better quality. But this wasn't the quarter to own those. What have we been doing lately? Well, we've continued to add to Taiwan, which was an overweight for us anyway, and China. We've added to China internet-related businesses, smaller ones rather than the big Alibaba and Tencent giants. We've already owned a lot of Tencent anyway. And added to work-from-home beneficiaries, again, especially in Taiwan. The companies that are making the components, the notebooks, and the data center kit and the cloud. We continue to reduce India, which we were underweight anyway, and the energy sector. At $30, even if oil recovers to $30, I see very few companies actually able to cover their costs at that price. So that's something has changed there. Now that still leaves perhaps some of the Russian ones, but everything else doesn't look very good to us, and we still don't like the look of Saudi Arabia. So we think that it's possible to imagine much more negative scenarios in place in Saudi Arabia than I think the market is pricing in. Basically, there's obviously a decision to be made here. Markets have fallen a lot and started to bounce already. The short-term positioning of fund managers is very bearish. The consensus is bearish. Therefore, the pain trade is to rally. Now, managers are cashed up and super bearish, and most managers are talking, and strategists are talking about U shapes and W shapes and all this alphabet stuff that I really don't like to get sucked into talking about, because they mean different things to different people, and I think it hinders communication as much as helps. But we do not see that kind of recovery. We see policy response being super bullish, unprecedented. Now, I know we're all throwing that word around at the moment so much, but $9 trillion of monetary policy response from the US alone and $7 trillion from fiscal is unprecedented. This is wartime-like response. Now, there are going to be dramatic changes for the future, whether we're talking about tax, which will be going up but not enough, and deficits, which are going to be a real problem. We're also, I think, going to see more and more government interference. We've seen peak capitalism, I think, in many countries. So we're going to have to get used to working in this environment and investing in this environment now going forward, where governments have started to interfere, and I think they will interfere in many countries more and more, possibly to deal with the unintended consequences of their policy response on top of the coronavirus crisis. So that leaves us in with a debate about whether we stick with our internet, IT, software, gaming names, the likes of CD Projekt in Poland that we've had, that has been a fantastic performer now for a long time, and it just gets more and more positive, or whether we start to look for bargains in beaten down sectors. And I think the answer for us is to somewhat still to do both. We don't want to get caught in the middle. We do not want to be buying low quality, but there are some industrials and some quality companies that will give you some exposure to that upside, which we're starting to look at now. But if we've still got a strong, solid story with momentum in fundamentals, in the underlying fundamentals of the business, in those sectors that are working in IT and in software and so on, we are still sticking with those as well. This will vary on the country in particular. So at the moment, well, let's go through a few charts and see what they're telling us. So on slide 3, just putting this in to show that the emerging markets have not behaved the same as the developed markets. So since the beginning of 2020, you can see that developed markets, quality and growth have led the way. That growth and quality outperformance is probably showing you the outperformance of the tech sector, the NASDAQ, the healthcare sectors. But quality in emerging markets has not performed as well. That's probably to do with the importance of some of the staples that have got hurt. India, which has a big representation, which has done poorly, and the fact that those Chinese banks have done well, which are certainly not in either of those segments. And if we go on to the next page, on page 4, you can see the performance by country, and as you probably already know, China, certain amount of first in, first out. They were very late in dealing with this crisis. I think there was some denial. There was probably the bureaucracy. China does not, I don't want to talk in stereotypes, but the system in China does not deal with information flow very well. Okay, it's a command and control economy still in many places. It's not a democratic market society, so the information is not quite so good in many places and response. But when it did respond, it has the advantages of that command control structure and the party mechanism, and the response eventually was draconian. So they are coming out of this crisis relatively quickly, the coronavirus crisis. Factories are back up and running. Restaurants are open. However, productivity is not quite so high. So if we talk about growth rates, it will look like a V. But as we all know, if a stock falls 80% and then bounces 80%, it does not get back to the same price as it started. That's the same as the economy. So it's a V shape when you look at the flows, when you look at the percentage changes, but that doesn't mean we end up back where we started. There's a productivity hit. So every factory is producing, not every factory, but many factories are producing not quite the same as they were before, even though they've bounced back very strongly and everybody's back at work because of the distancing rules and the other impositions that are in place. An easy example, but an exaggerated one, is to think about a restaurant. The restaurants are open in most Chinese cities again, and many Chinese are eagerly going back to those restaurants. In fact, they're flitting from one restaurant to another. They'll do more than 1 or 2 a night because they're trying to go and see them again. However, each restaurant no longer has the same capacity as it had before the coronavirus hit because of the 2 meters between tables. So they've got fewer covers. So that's a useful analogy to have in mind, I think. It's an extreme one, but one to bear in mind. You can see there India is starting to bounce back already, but Brazil doing very, very poorly in the early part of this crisis on the left-hand side. But we were underweight Brazil and we were overweight China, so that seemed to go okay. And these are relative charts, of course. And then on the right-hand side, You can see Mexico, where we've been very bearish on for quite some time. Almost no weighting in Brazil, sorry, in Mexico for most of this period. They're one of the worst performers. South Africa, I'm afraid, being a very poor performer there as well on the right-hand side. The best performer on the chart on the right being Taiwan. And we've liked Taiwan throughout this period, so that's been a mild benefit to us. Not huge weightings in here, but positive, and are very, very heavily into the tech sector, although we're starting to spread out from that now. But yeah, high quality names, good tech names, we'll talk about those later on. Attribution by country, so this is the, how we've actually generated that outperformance, a stress outperformance on a relative basis. So stock selection has been very positive over this period, but there was also some positive from the country selection as well. And you can see on this first column there, you can see stock selection good in emerging Asia, very strong in China, but negative in India and Thailand. As I mentioned before, that's where we've got our hotels. And then in emerging Europe, Middle East and Africa, a very strong number there coming out from Poland in particular, where we have that CD Projekt, which is a software games company. You might have seen the spin-off on Netflix of Witcher, but their Witcher game is very successful, but we're really looking forward to a new launch called Cyberpunk. Whether we'll still be owning that name at launch date, I don't know. Sometimes it's better to travel than arrive on these things, but it's been a huge bull market in that company for us for quite some time. And then you can see on the country selection, not so good in emerging Asia, but very good there elsewhere. South Africa obviously being showing up as a big positive, and Latin America, our underweights there being very strong. And we had a nice little help from a bit of cash where we allowed that to accumulate slightly, which also gave us a bit of help. Also, timing impacts of buying things well during the quarter will show up there. So a little bit of that, a little bit of buying a few things in India after the collapse helped. Performance by sector, well, these won't surprise anybody. You can see the worst performing sector being energy over this period, but note the bounce back from the lows has been quite significant as well. We worry that capacity is not being withdrawn in the energy sector as it should. So I'm not particularly tempted to be too heroic there. Consumer discretionary doing okay, but that's rather mixed in different countries actually, but it is doing well. So those strong structural long-term stories in emerging markets holding up slightly better. On the right-hand side, you can see the big winners out of all this is healthcare and communication services. Communication services including the internet names. Well, we've certainly got quite a bit of that, so that has helped us a lot. But it's definitely gone beyond the Alibabas over this period and into more specialist and more niche names that have done very well over this crisis. And IT in general also outperforming. Financials, of course, well, this is a deflationary shock. It's an oil glut, a deflationary shock, and a demand shock. That is not good for financials. Interest rates have been axed again. We're awash of money, but also there's bad credit out there. So if we look at the sector attribution, you can see here on page 7, this is broken down in a different way, and you can see here pretty much repeating the same. So energy was a negative impact because the stocks we had did very, very poorly, even though we were underweight. Materials, they're being very positive. We were underweight the sector, which is a positive, and we were overweight the right names within it, the Anhui Conscious and so on. Which has been very positive for us. Consumer discretionary was actually a negative because of those hotels, even though it was right to be in that sector. Consumer staples obviously being pretty good in times like this. We didn't have enough of the right healthcare names, which is a shame. Financials, we were hurt by not owning China and owning India. But IT was very, very strong, and communications was very, very strong. So the media names, the internet names, really helping us out there in communication services, and the other internet and technology names, the work from home beneficiaries, doing very well in IT for us, and they really made the difference. Utilities, we don't have much in the way of utilities, but what we do have, we have a water company, which is obviously a reasonably good place to hide at the moment. and real estate actually remarkably positive. This liquidity has got to go somewhere, and some will believe that real estate could be a beneficiary, although we'd be very wary of commercial real estate. So just the same, the top 5 performers here, I've discussed some of these already, so I won't talk about China Education and WeConch and Acton Technology yet again, but they are here at the top of the table. China Feihe is a infant milk formula company in China. Obviously, again, people fleeing a bit to quality, these sort of staples doing very well. This was a relatively new listing that we've had for a while, and it's performed very well for us. Itching to take profit in this name now, actually, but it's certainly done its job and delivered for us. It's a company that thinks that tells Chinese mothers that their infant formula is better suited to Chinese babies than foreign brands. I will offer no opinion on that, but the marketing has worked. LG Chem, well, the interesting bit about LG Chem is it makes batteries for electric vehicles, and obviously there was good news from Tesla during this period, and it gained from that improving sentiment. And then the bottom detractors, well, Mint Group is in the auto sector and global, so it isn't benefiting from that Asia being first in and first out. Minor is the hotel company, as is Lemon Tree, so we talked about those already. And then we've got a bank in there. We're underweight banks, but the ones we have done very, very poorly. So portfolio characteristics on 9, we look as we normally do with a focus on profitability. The companies in our portfolio have higher levels of profitability than the index. That's what this rather bizarre chart is showing you. Our company is also growing quicker than the index, so the growth is overweight in this style exposure and earnings variability. And we've been outperforming lately, so the momentum is positive. Leverage is negative. That means our companies have less debt than the index as a whole. All these attributes seem pretty good to have at the moment. They seem rare. The risks of having too much debt at the moment is obviously very high. There's a lot of money out there, but if you need it, you probably can't get any. Size at the moment, that was showing that we are of a slightly smaller portfolio on average than the index, but we've also got some giant companies in the portfolio, so I'm not sure that's as significant at the moment. And unfortunately, we can't find companies with better balance sheets, better levels of profitability, faster growth, and yet cheaper than the index, so value is still the wrong side. I do expect that dividend underweight to come down going forward. I think there's a bit of a yield shortage going on, so we're sort of looking at high quality companies that are paying a divvy. They won't be high dividend payers, but they will be dividend payers, I think, going forward, except for those internet names. So the transactions during the quarter on page 10, we rotated into LG H&H, Household and Healthcare, away from Amore Pacific. They're very similar businesses, but we prefer the distribution model and product mix of LG H&H in times like this. Amore Pacific doesn't have the sort of standard fast-moving consumer goods that LG H&H has. It's more purely on makeup, which LG H&H has as well, and cosmetics. But also its distribution model is a little bit more, still has some door-to-door type approach, which I think I prefer the more internet-focused LG H&H model at the moment than the Amore Pacific door-to-door one, although they both do both. And that's worked. Quanta computing, I mentioned, I think this sort of name already. It's a beneficiary of data center capex. We've all, you can imagine many firms have bought their employees more notebooks, so that business is looking good. But the data center growth is rapidly increasing as everybody all over the world looks to sign on and do Skype calls like we're doing now, or work from home. And this is a key player in that supply chain. It has a good return on invested capital, and that's improving. It pays a very good yield. It's a very good safe stock in that technology space. Highwind is definitely more cyclical. It's got a very good return on capital, but it is cyclical. This is a factory automation play, and we see those trends accelerating as well. Then there's Naver. Well, this is a business that we've liked for a long time. It is not as good as the US or Chinese online businesses, but it's still very good in Korea and also good Japan exposure. It's got gaming, it's got social media. we've been this has been on the edge of the portfolio for a while, and we just finally, bought it back again just in time before this crisis really sent these sort of stocks rocketing higher, and we were very glad we got that just in time. And then the Ulka Biscuits, a strong biscuit company, real staple, very steady, good cash flow, usual type of thing that you do in times like this. And what have we sold? Well, we sold some AirTac to keep the IT and industrial linked exposure down to reasonable levels. And, this has been a good name for us, but we didn't want quite so much cyclical CapEx exposure at the beginning of this coronavirus escalation, and that proved good and gave us the capital to invest in some of those other names I was talking about. Now, there's a mea culpa coming up. Reliance Industries. I sold this. This was me. I thought that they were very heavily indebted company, Indian conglomerate in many areas, but also in energy. And I thought they were going to struggle to deleverage because they were going to sell part of their downstream petrochem business to a Middle Eastern player. And I thought I could see this deal not coming off. So I sold it. Well, unfortunately, being a typical Indian entrepreneur, he's done the deal and deleveraged by selling part of his telecoms business to Facebook. This has obviously been taken very positively, and I now look very foolish. JD.com, we just took profit in this online company, done very, very well. We probably sold it too early, but it had been a good, profitable position for us. WinSemi, we sold at the beginning of this crisis because we thought things are going to get worse, and again, that was probably the correct thing to do. And MediaTek, we took profit in this name as well. It's a very strong player from 5G, fabless chip design. We thought there's a lot of negative news flow coming. We've actually gone and topped this up again as the price fell after we sold it, and we made some good money elsewhere. This is a very strong key name for us, but it doesn't mean we won't trade around it a little bit to try and make that capital work as hard as it can for you. Capital tension is very important to us. We think if we can keep the capital tight in the right place at all times, we don't have to take the risk. We can still get good returns for less risk through capital tension. So obviously diversification is very important, but I think the capital tension is something that our industry underappreciates. You can see here where we were positioned at April 30th. I'm not sure there's much to add here. You probably gather the gist of it. We're still underweight those countries that are at higher risk from things getting out of hand. So that's South Africa and the GCC. We are overweight the sort of countries that were first into this crisis, such as China and emerging Asia, or those that have dealt with it very well, Taiwan. We read a lot about countries with having different attitudes to this crisis, whether it's South Africa or Brazil or India at one extreme, or Sweden having a different approach, or Germany. But in fact, the best country so far by a street mile is Taiwan. Very, very good public health response. But then the people of Taiwan excuse me, have dealt with these issues before. Everybody in the community has good reflexes. They've got stocks and masks themselves, and they know how to use the app to do the tracking. But unfortunately, the WHO, being sponsored by China, isn't too keen on telling us how well Taiwan are doing. So moving on to sector allocation, at the moment we are still in the holding on to the consumer discretionaries, the consumer staples, and those fantastic IT and internet names. So communication services here looks like a neutral, but within it we're very, very overweight IT and underweight old-fashioned telecoms. So you're in the internet names, IT names, staples and discretionary. All sounds very safe, doesn't it? You can see we're starting to buy real estate as we think the money's going to go somewhere. But in fact, there's a huge debate going on about the timing of how we rotate out of this and start to get more exposure to industrials in particular, but maybe also more cyclical names, because the response has been so powerful from the authorities and nobody owns them. So that's what I'm going to go into now and deal with a bit of this. So apologies for all the general maintenance stuff there. Now we're going to get onto something a bit more interesting. So the global monetary backdrop, this is for the whole world, not just for emerging markets. But that's where the story has been, really. As a rule, some of the bigger emerging markets have reacted in an orthodox manner, but the largest economies have in the world, and the G7 have acted in an unorthodox manner. Completely unprecedented, as we'll see as this goes forward. So money growth is surging on page 14. Now this normally suggests a strong 2021 economy, and it could lead to a release of some of the deflationary pressures. Now this will, we think, lead to some inflation somewhere, but it may not be the same inflation as we all used to read about in our history books. So this will be different that some of us remember inflation before. Where it will pop up is something that we've got to go and find out. Where are the bottlenecks? Where will be the unintended consequences of this unprecedented government response? But you can see here these numbers are vast. So at the moment it looks like another GFC, but as we go forward the next few months, this is going to be bigger. Okay, we've already had a PMI reading in India of 5, which I think is the lowest I've seen anywhere ever. And the money that's being, I think we can actually now say printed elsewhere in the world is also unprecedented, and it will be. And the fiscal response as well is enormous. So as we look at these charts, bear in mind that these are probably lagging slightly. So we're seeing, now this is very important. If all that happens is narrow money accelerates and the economy collapses, then it's just the same as the last 10 years. Lots of money and pockets of growth, and we have to find the growth. And then that's where the bull market will be. And the money will go into bonds again, and although they can't, I'm not sure how low they can push those yields. And then probably now some IG credit if you're front running the Fed, and then probably property and the hot equities, the high quality growth equities, and private equity and everything else. But I think this is going to be different. Now, how we tell, while we're still in this moment where we're not sure yet, how we tell whether this is going to be different to the GFC response is we start watching broad money. So after the GFC, narrow money bounced, as we can see in the chart on the left, but broad money didn't. And if those of us that were, know Japan from the old days after its bubble burst, broad money never did much in Japan. So it was just narrow money. So the whole Japan post-89 was occasional trading rallies, but no real change. And you can say that's because there wasn't any creative destruction, people didn't go bust. Well, that's probably sounding familiar if everybody's being bailed out here in the West. Or you could say that the banks weren't solvent enough. Could be the same again. But either way, you didn't get broad money growth. The money didn't get wrenched from where it needed to go, from where people needed to, there was no creative destruction process to shift that capital to how we were going to grow out of this problem. And so there are similarities to that. To work out whether there will be money growth or not, we have to look at broad money, and you can look at the credit data from the banks. Now, initial signs are it is being turned into broad money. So that would mean that everybody's super bearish positioning is going to be wrong. Now, there is a caveat here. In the initial days of a crisis like this, having seen a fair few of these, every CFO affected in the crisis will draw down their borrowing. They will borrow even if they don't need to, because you don't know whether that facility will be there in a few months' time. So you saw this immediately. As soon as the crisis started to hit, Boeing drew down its massive loan facilities, and I mean all of them. So you can say, well, Boeing probably needed them, but every CFO is going to draw them down if they think they need them. They might need them. So you do see a spike in asset growth at the banks as that happens. But once we go through that, which will be about now, if this broad money growth still continues, then we know that there will be pockets of growth, that the recovery will happen. It will happen in a very odd manner, because I still think there are problems in that people are not going bust. Overcapacity areas are not going to see relief, but other areas at least will see some loan growth. So here's some more pictures of the same thing. Fed liquidity is just enormous. Other central banks' responses are also very large, especially the Bank of England's. but they are, they're nothing compared to the acceleration we're seeing in the Fed. Now, if this continues, and I know there's an argument that the Fed is just acting as, the central banker of last resort for the whole world, and they're opening their own Fed branches all over the world. Yes, that is true, but at some point, your money's growing faster than everybody else's. You should cap the dollar. Now, this is very important because there's a massive dollar shortage. In the last bull market we've had, there are many games being played throughout the economies of people borrowing US dollars. Now, they have to race to pay those back in many cases, or a leverage is being unwound, or people are just going for the safety of the US dollar. But this dollar bull market is an indicator that the Fed hasn't done enough to counter the dollar shortage that is going on. So watching the value of the dollar is very important at the moment. I'll touch on that later. Recovery has been held back by exports of China, but we actually, having said that, we had a very good China export number out day before yesterday. But what is interesting about these charts on page 16 is that, yes, that China, you've got that China V shape, but remember that is a growth rate or a survey, not an absolute level. But look at the right-hand chart, and the China narrow money is recovering. But look at the red line, loan approvals, on page 16. The loan approval chart is right back to those huge cyclical boom that China went through after the GFC, and they turned on the taps. Now, I'm normally a little bit rude about this, but let's be honest, the People's Bank of China has tools available that are not available to other central bankers. We joked that the Bank of England governor raises his eyebrow or invites bankers around for tea, although these days it's a Skype call, to bully them into doing what he wants. But the PBOC has much more powerful means at its disposal, and I often joke that the AK-47 is the policy tool of choice for the People's Bank of China if they really want to get bankers lending. But it looks like, according to that survey, they're going to do so. So if we go back to that broad money argument, is this narrow money growth, this money printing by the central banks, going to lead to real loan growth? China looks like yes. Whether the other countries will or not, we have to wait and see. And then I've got lots of charts here showing this real narrow money growth exploding in almost every country. So when it's all exploding like this, picking one versus the other is just on this number is actually less important, because they're just all going to play catch up with one another 1 month to the other. It will settle down, and we will get some bigger winners and losers. But I think at the moment, we just have to say they're all very positive, and the global picture is very positive. The world is awash with money, but there are some big holes of credit destruction going on, possibly in Europe, but definitely in the Permian Basin and the oil sector. That's destroying this as quick as perhaps the Fed is printing it. But when the Fed gets to a tipping point, which it's obviously determined to do, there will be a lot of money around. So that leads us to say, okay, so in a recovery, who does well? So we now look at performance before and after a global stock building cycle. Now, the first one here is an absolute. So MSCI World, this is on page 18, in US dollars, falls just under 6% in the 18 months before the bottom of the cycle. And it rallies on average, this is an average of the last 7 cycles, nearly 23%. That sounds great, doesn't it? But now let's look at the others. And these are on a relative basis. So the US does better 18 months before the trough, and still outperforms, but by less after the trough. Wouldn't be surprised if that's going to be the case this time as well. Emerging markets do much worse before the trough and much better after the trough. Cyclicals, similarly. The commodities, even more so. Underperformed by 15% in the down market 18 months before, and then 23% outperformance of a 22% performance. You made actually a huge rally afterwards. And the dollar, usually strong before, a little bit softer afterwards. So we just thought that was interesting. And then individual countries you can see here as well. China sort of does its own thing in the old days. I'm not sure that's going to be quite as relevant going forward. Indonesia, very sensitive. India does its own thing as well. But you see the commodity producers there very sensitive to that. Russia being an extreme example. South Africa doing something slightly different. I'll leave you to ponder for that one. So how are emerging markets going to do? Well, we have a checklist. We've been using this checklist for decades. We thought we'd think of it as a traffic light system, and it's been pretty useful. Now, one day this won't work, but it's actually worked pretty well for the last 27 years or whatever. And it's very simple, and you can work this out yourself, because obviously there's some subjective elements to this. But basically, we look at these 7 factors, and we go real money growth. Is the E7 above the G7? No. But when everything is growing as fast as it is growing now in terms of money growth, that might not be so important. Valuations, are emerging markets lower than developed markets, and are they cheap in absolute terms? Well, the answer is a very strong yes on both counts. Earnings revision ratios, are they above developed markets? Yes. They're both collapsing, but they're above developed markets, and we actually think they might recover quicker. Is the global industrial cycle in an upswing? The answer is no, but looking at those charts I've just shown, they could be bottoming, but this could be a very weird cycle. So we leave that one at neutral. Global excess money, well, yes, there is more global excess money than we've ever seen and probably ever will see. Commodity prices, are they in an upswing? No. Now, it's very different, of course, whether you've got energy in this or not. And emerging markets, many of them are oil price importers nowadays, whereas they used to be all exporters. But are we in an upswing? Well, we're definitely not in an upswing. You could argue that most of them are bottoming. And then the one that I'm most sensitive to in the short term, the dollar. Usually emerging markets do well when the dollar is falling, and we can't say that at the moment. At the moment, we've still got this as a red light, but we are wondering if it is peaking here because of looking at the actions of the Fed. It seems to be there. What they want to do is to stop it rallying at least. Now, to look into these in a bit more detail, we've got a couple more charts, but I feel I've been speaking for too long and I want to leave room for questions. But this China one is important. So if you look at the G7 versus E7, I think that's going to catch up with the response as China starts to kick in. And the earnings revision ratios, well, they all look awful, but emerging markets are less bad. And I think they will bounce as China is first in and first out. So our strategy on page 22, this is, going to use that word again, unprecedented fiscal and monetary stimulus. We will see a strong recovery. But I'm saying the growth rates look V-shaped, but that doesn't mean the economy will be V-shaped. We're not going to get back to the old level. But 2021 will look very odd and will be quite remarkable, I'm sure. Equity markets are already discounting a return to growth. You can see how they behaved in the countries that are first in. Looking through it, looking to see what the new normal will look like. As infections peak, they don't wait for things to get better. So we remain overweight IT and internet, consumer discretionary and staples, and underweight materials, telecoms, autos and energy. But we are adding to that second group as we start to look for the recoveries. Now that doesn't mean we're going to buy the lower quality names. We want to buy the good quality names. Capital will remain abundant, but probably unavailable to anybody who really needs it in those sectors, unless they're in a sector favoured by a government official, when they probably will get the capital and ruin the profitability for everybody in that industry. That is something we're going to have to watch more and more throughout the world now. Overweight China and Taiwan, I think we'll be sticking with that for a bit longer. We might take a little bit of money out of Taiwan just because it's done so well and has done so well in this crisis, but I think Taiwan could be a big winner out of the trade war. If the trade war heats up again, Taiwan could be the way that these sides don't wreck the US and China, don't wreck the world economy, but still manage to pretend to be very angry with one another. They could continue to conduct business through Taiwan, rather like the West and China did through Hong Kong, which could mean Taiwan's a big winner. We are at the moment underweight India, South Africa and the GCC. I don't see that changing significantly except for India. You see a PMI of 5. I don't think it's going any lower. And there are some fantastic companies in India. So that's a market where we're not ready to get confident on yet, but we are looking at opportunities to add to some very good quality names as we see the money numbers change and as we see that extreme lockdown that India has start to loosen, start to become a bit more sensible. We think there's actually some bargains here in the quality and quality growth areas, and we're starting to look at names that are quality but in the more economically sensitive area. We're starting to look as that EM checklist becomes more bullish. I would caveat that with saying watch out for the US dollar in the short term. So that concludes this this wrap. I've tried to do two things at the same time, which is show you outlook as well as give an update on the performance of the fund, both good and bad elements of it. But I do want to leave as much time for questions as we can. As just a quick firm update, we've been really pleased that both on our global business but also on our emerging market business, especially in our emerging market business, actually, we've seen continued inflows throughout this crisis, which I think speaks volumes of our clients, which I'm very proud of, reacting to this in that way and knowing that you should generally do the opposite of what you emotionally want to do, and to keep your head in times like this. So thank you very much, and open up to questions, please, Anil.
Thanks, Ian. Yeah, I mean, it definitely seems like there has been some kind of delayed reaction where people have been waiting for a pullback in EM to throw some money in.
That's right, yes. I think that's definitely been the case. I think a lot of its positioning, there's lots of liquidity out there, quite scary numbers, but definitely, well, we've personally seen significant inflows.
Yeah, and Ian, the questions are rolling in now. So just in terms of healthcare, so just the one chart you showed relative to the MSCI EM index, there's been a bit of a pullback relatively in April. Just some additional comments on that?
Yeah, I think this is, there's a number of different companies in here. It's obviously a good cash cow usually. A lot of healthcare companies are either beneficiaries of the coronavirus or are unlikely to be affected too much. Some will be, however, because obviously a lot of hospital work isn't doing. We have a few concerns about the healthcare industry in China in certain parts. We have a healthcare name which we're very, very pleased about, which is trying to integrate technology into the healthcare sector. And we'd quite like to get exposure to a couple of other names as well, if we get the opportunity. But I'm not really in the mood to go and invest wholesale into it here. I think it's been a very defensive sector, and now it's probably might have done its stuff. It's been a good place to hide. So there are exceptions out there. Some are exceptional companies in there that are very exciting, and maybe the odd hospital could be a good recovery play. But if you pardon the pun. But no, I think it's difficult to get quite so excited about that sector here in the short term. But obviously it's in common with some of the consumer names, very solid, long-term, attractive business in emerging markets. But maybe they've done their bit now. There's some regulatory change coming in China still rolling through, which has made it a bit difficult for some of them to have any pricing power.
Thanks, Ian. And just your style has tended to be quality growth, which obviously very different to value in many respects. And value, as we've seen, hasn't really worked whether it's DM or EM for quite a long period of time now. Just maybe some comments on that.
Yeah. So I'm less anti-value in the developed markets than I am in the emerging. I mean, we are a quality growth manager. This is the way we analyze companies, and this is our style, our house style, and mine as well. I think that's a little bit more helpful in emerging than developed, because I suppose the theory about value investing, isn't it, the way I see it, is you buy really good assets that have got good cash generating potential that are cheap, and it must be cheap for a reason. So either the market's wrong or something needs to change. So the better value investors, I think, have a quality element to it, or they look for a catalyst. And the catalyst is usually the company gets bought, or new management come along, or it gets taken over, or new management come along and improve the return on the capital. And then the market goes, hey, it's a good company after all. And then it gets revalued. That to me seems to be the process. It's a bit risky to rely on that in emerging markets. the institutional framework often isn't there. The institutional investing industry doesn't have as much power often, not always. There can be entrenched management or some other conflict of interest that might be more common than there is in developed markets. The company might be really good, but not being run for the minority shareholders. That wouldn't be unusual. Whether it's because the state is involved or there's another family business that actually is the one that's really making the money. All these things can mean that value investing is a bit harder. But also, if you're in a growth area like you are in emerging markets, in many places anyway, then it makes sense to get those quality names that are going to capture the return on invested capital from that structural growth. And that's probably why, you don't use the value investing in any structural growth area, because you're going to make more money by getting the trajectory of the growth rate right, the trajectory of the return on invested capital versus the cost of capital right. We use the same toolkit, I'm sure, as a value investor, but we just look at it more from where is the return on invested capital going relative to its cost of capital, and then how much do we pay for that, rather than the other way around. And I think in emerging markets, it has proven to be the right approach. There can always be a quarter or two where there's a switch around, but I think in the long run that seems to make a lot of sense to me. We've avoided many things by talking to companies and discovering, where their return on invested capital is going to go, or whether they really care about minority investors.
Thanks, Ian. And just another question came in about just the huge amount of liquidity that is currently awash in global markets. But the question is, will it be available when corporates need it the most?
That's a brilliant question. So this is the story of Japan, I think, when they went through this, and the story of the last 10 years, isn't it? Lots of liquidity, but you can see by our portfolio, we generally had stocks, despite all that liquidity and low interest rates and eventually some growth, we still stuck with companies that had business models that generated their own cash. They didn't need other people's money. And that's because liquidity was plentiful, but not if you needed it. However, this might be different this time, so we'll have to be a bit more careful about being that generalization. But at the moment, we're still in with companies that do not need other people's money, in case that is the situation. I think there's a typical cycle here. So usually in this crisis, the authorities respond, you get lots of liquidity. Yes, there's a relief bounce in people that are not going to go bust where you thought they were going to go bust. But generally, your quality names still do very well, because the banks aren't really being very helpful, despite the fact that rates are low and liquidity is plentiful. Now, what I suspect will happen is that we will at some point move out of that environment, and the authorities will force the banks to lend. But obviously the banks are still going to lend to things they want to lend to if they can help it. So we still want to find the strong areas. So I'm not advocating we buy heavily indebted things, but we might want to look at some different types of businesses going forward.
And Ian, the other question that's come in is, are you considering buying more shares in Reliance?
I'm licking my wounds and being a bit foolish. I'm letting it go initially. It's obviously a game changer, the Facebook deal. Although we're hearing rumours about Google investing in one of the rivals now as well. It's a game changer. It does change things. It has deleveraged. Yeah, I think it will revolutionise that industry. So I'm not going to say that I won't. How about that? Apologies for the double negative. I can get into all sorts of trouble with telling you what I'm going to do next.
Mm. And then Ian, you mentioned about fabless chip design. So just if you can please elaborate a bit more on what that actually means.
Yes. So I'll do this with a bit of a history lesson. So in the olden days of tech, when it was dominated by the US and to a certain extent the Japanese, companies were fully integrated. So they designed the chip and then they built it. And then along came a chap called Morris Chang, and he founded a company called TSMC, Taiwan Semiconductor, and he realized that these are very different businesses, and lots of companies need a chip or could design a chip, even differently again, and they don't need to make them. They could outsource the manufacture of that chip because it's a very different skill set and a very different business. And so he built basically a whole new industry, which is what Taiwan Semiconductor TSMC does now, which is making the chips and other people design them. So more and more companies in the tech space are designing their own chips. Apple, for instance, designs them, doesn't make them. Okay, so it's revolutionized the world, this technology. And it means a lot of companies that just design chips, we call those fabless chip designers, or that are making something else in the supply chain, but are designing their own to meet the specialist functions that they might need for something that's really tricky or really difficult, whether it's in AI or in your mobile phone as it gets smaller, and or whatever. And so this means that somebody like TSMC, which is the dominant player in this space that actually makes them, they just make them. They will help you design them, but they just make them, and you outsource it all to them. So if you don't have scale in I've sort of answered a different question now. So the fabless ones, which we love, can have a very, very high return on capital because it's just a few kids straight out of university in white coats designing chips, not actually making them. And then they go to TSMC, and he's the one putting in many, many billions of dollars every year into building plants to build these chips, and every year they get better and better and smaller and more efficient with higher yields. So it's a real winner take all. That other section is a real winner take all business. You don't want to be in the second best chip manufacturer. And so we've always backed TSMC, and it's been a very, very successful investment for us for decades. But at the same time, you can be in all sorts of specialist niche players in the fabless chip, or in the company that's making things and designing their own chips to go in them, such as Apple. So this technology, and ARM, TSMC, Apple, these dominant players have done incredibly well as this industry has broken up from it just being one company that made everything.
Okay, thanks, Ian. And just in terms of
and so that was our MediaTek example was one of these companies that is going to be a huge beneficiary as over the last year with the trade war. Huawei, for instance, and many Chinese companies could not get access to some of the US technology. So we've seen a Asian shift in the supply chain. So you can imagine how big the supply chains are for these giants, whether it's Apple on one side or Huawei on the other. And the Huawei one, Huawei's been incredibly successful. As they shift their supply chain towards Asia, you've seen, US firms lose business and Chinese firms and other Asian firms gain business. And we've been obviously playing that, and MediaTek was one of the beneficiaries of that.
Thanks, Ian. And just what is the importance of the USD on emerging market growth? So why did you cite that as being quite important?
Well, there's a number of factors. It impacts them directly because of where their debt is and what price their trade, what currency their trade is priced in. But also it's an indicator of what's happening at the capital. So if there's a dollar shortage, a lot of these countries have borrowed in dollars, they have to repay in dollars, and you can just see it's like an indicator of a loud sucking sound as all the dollar just sucks it all up, and as people flee and fight there. So two things. One, there is a fundamental reason which impacts on their terms of trade and through their balance of payments. And secondly, it is an indicator of whether we're in a deflationary shock still because of the dollar shortage and the crisis, or whether we're beginning to come out of it and the Fed's done enough. And both of those create a virtuous or a vicious circle. So it's really helpful to have that on your side and not working against you. So so that's it. It's just if it's flat, it's fine. But if it's still surging higher, that's an indicator that there's trouble somewhere.
And I guess related to that, about your comment on commodity prices, whether it's in an upswing or not, and specifically your thoughts on gold and PGMs.
Yes. No, I should have guessed that gold would be a key topic for your chaps. So obviously there's the gold element. I think many So I don't know about the short term. I'm not going to make a short-term call because it had a good rally. But I think in the short, I wish I'd stuck. I did that conference in South Africa, was it just over a year ago, and I said I quite liked gold and I wanted a short cannabis. It was probably the best trade I've done actually in the last 2 years. But going forward, I think there is an element of the currency debasement going on. So we've crossed the line here, right? When we've done QE, we didn't really print money. Okay, central banks purchased government securities in the secondary market effectively from the banks. But we're getting closer and closer to crossing the line of purchasing directly from governments, because the fiscal response, it was austerity last time. This time there's going to be no austerity. This time governments in the West are full-on fiscal boost at the same time as full-on monetary boost. That's new. That's the sort of thing that only happened in World War II. That's going to have ramifications. And so people looking to diversify, the big asset allocators in the world are starting to look for inflation hedges. Now, I don't think we're going to see inflation the way we expect to see it in the next year or so, but going forward, there's some big investors out there that they can't get yield, they can't get an inflation hedge, and they can't get they can't get anything that they know will keep pace in their big long-term pension schemes with future living standards. So what are they going to do? I think gold is going to start to increase in people's portfolios again in the long run. I think there's going to be a hunt for yield again, but it has to be a real yield rather than a manufactured one, because a manufactured one is a duration bet, and I don't think duration bets are looking very good at the moment. I don't think you can get this anyway through the many government securities anymore. Chinese government securities probably still look like they've got some yield left in them, but everybody else is they're zip, aren't they? So how does that help you? If you're running one of the big pension funds in the US or a big sovereign wealth fund in Asia or something, or Middle East, what do you do with that money? So I think, yes, I think people will start to increase allocations to gold again. Some of them already have. Being very wary about how you do that, of course, but I won't lecture your audience on that. So yeah, I think some of these, there will be money, some of this money will end up in that sort of asset class, chasing yield, but being very wary of the pockets of capital destruction in energy still, which has got a lot more to go, I think, unless it becomes like a zombie investment, or you wouldn't want to be invested in a retail REIT at the moment, would you either? So.
Thanks, Ian. I mean, we're really taking it out of you here. So just two more questions. So the first one is just on the US-China trade talks, which seem to be back on track. And do you think that's going to last?
Mixed opinions here. So you don't really want to start a trade war when your economy has been devastated, do you? But people do. So I think the good news that's come out lately, we thought a while ago had to happen anyway, because Huawei owns many of the best patents for 5G and stuff. So you've got to deal with them. Otherwise, you're going to be the ones in the court. But I still think there's potential for it to deteriorate, or for there to be flashpoints, and maybe it'd be less trade and more about the virus. The politicalization of the virus, or this is what happens if you look historically when there's been a pandemic, people blame the foreigner or the minority or whatever, which is very sad, but that's the pattern. So the Spanish flu epidemic that we had in the early 20th century actually started in Kansas. We don't call it the Kansas flu, do we? So yeah, that's a bit of a problem, I think. And so it could flare up again. There's a US presidential election. I think we've got a few things to worry about in the run up to that. I don't think people will be able to help themselves, and it will get a bit ugly. And of course, China's been pretty busy as well in terms of propaganda. Propaganda machines in all countries are on full. They're not they haven't been furloughed. All the propaganda guys are very, very busy in all countries. So I think, yes, it's good news, very good news actually, but I think it's still we could still face some more challenges in that, and we've still got our Taiwan plays on that.
Okay, Ian, and just the last question then, which I guess more relevant to the South African clients on the call. So what does South Africa need to do to become rated investment grade again?
Oh dear. How long have we got, Anil?
Let's say 2 minutes.
We all know, I'm having a quick look to see how many people we've still got on the call. We all know the issues in South Africa. I could give a long list of detailed policy responses, but we know that that's not really the problem. So when we do our ratings on emerging markets, and we do our long-term ratings, we look at institutional quality. So even when we do our ESG analysis, it doesn't matter what your minor reforms are. It's, do you have the governance? Do you have the institutional quality to make sure that they are secure, that your institutions are secure? So there are many reforms that South Africa needs to do, but can you do those, or can they be actually implemented and then remain without being unwound again or ignored if you don't have the institutional quality improving again? So South Africa is a very unusual case in that it had relatively high institutional quality score, but it is deteriorating, or has deteriorated, I should say, over the last 10 years. And that is unusual, and that is the problem, I think. So yeah, there's loads of policy responses that we need to do. I think we all know what they are. But if you don't fix the governance side, you're sort of doing it the wrong way around, I think. But there's plenty of countries that are worse. South Africa, I think, is not as bad as the locals think, but that's because, again, it started from a high level and has deteriorated, which is unusual. So the country that is bad and doesn't improve is something like Argentina. And Brian will remind me that I think Argentina is on its 9th default. And at the beginning of the 20th century, was richer than Germany, and yet still it really struggles to call itself an emerging market. It's really below emerging status. So institutional quality is very important, and I think the biggest thing for South Africa is proper reform that secures that first. Then you can go on and do all the other ones that it's easier to talk about and easier to describe.
Okay, great, Ian. Thanks very much for your insights and expertise. I think we really covered quite a lot of bases today.
The trouble with reform is it's painful, isn't it? So usually there's a bit of a crisis before the real big, world famous reforms come in place.
Okay, great. Thanks very much. To our valued investors, just please feel free to contact us if you have any additional questions or concerns. And yeah, just best wishes for the rest of the day. Just have a safe weekend and best wishes to your families. We look forward to connecting with you again soon. Thanks, Ian, and thanks to everyone on the call.
Thank you very much, and stay safe, everyone.